If you're in an airplane, you can't afford to run out of fuel. So you plan your trip ahead of time and determine how much fuel you'll need to get from here to there. Retirement income planning works much the same way. It's a long journey, and you cannot afford to run out of money. And retirement income planning is a lot more complicated than calculating how many miles you can go on a tank of fuel. To help you visualize the risk of running out of money when in your 80s and 90s, we're sharing with you new research we've licensed from Dr. Craig Israelson, who teaches in the financial planning program at Utah Valley University. Israelson backtested the survival rates of 4 retirement portfolios based on 90 years of historical performance data for U.S. stocks, bonds, and cash. This chart shows that an all-bond retirement portfolio survived at least 35 years, only 44.6% of the time, over the past 90 years. However, a 4-asset diversified retirement portfolio lasted at least 35 years, 98.2% of the time. To be clear, there were 56 rolling calendar year 35-year periods between 1926 and 2015. The first 35-year period was from 1926 to 1960, the second from 1927 to 1961, and so on. The numbers in the table represent the percentage of time that these 4 retirement portfolios lasted at least 35 years over the past 90 years. This table is the traditional way to illustrate the survival rates of different portfolios, but it's not so easy to take it all in. What this table does not show is how long portfolios survived when they didn't last at least 35 years. You have no idea whether a portfolio that did not last 35 years survived 34 years, 30 years, or 24 years. That's where this new way of visualizing your retirement portfolio comes in. These are radar graphs, and they offer a unique way to visualize the longevity or survival rate of different retirement portfolios over rolling time periods. Each dot, green in the all bond portfolio and purple in the 65-35 4-asset portfolio, represent a 35-year period. The dots on the outer red ring survived at least 35 years. As the dots cave in toward the center, it indicates that during that particular 35-year period, the retirement portfolio lasted less than 35 years. The darker black circles indicate 30-year, 20-year, and 10-year survival periods. Look how many times the all bond portfolio failed to last 35 years. Not only are they far from the 35-year survival period, but many of the 56 rolling periods lasted less than 25 years. Keep in mind, these two graphs assume an initial withdrawal rate of 4% that is adjusted for inflation by 3% annually. Look at what happens when the withdrawal rate is 5%. There are even more green dots in the all bond portfolio caving in toward the center, indicating shorter survival periods during retirement. In contrast, at a 5% withdrawal rate, the 65-35 portfolio experienced very little caving in. Historically, a diversified 4-asset class portfolio has been able to survive for at least 35 years far more often than an all-bond retirement portfolio. No one can predict the future, and past performance is not a guarantee of your investment results going forward. But I'm hoping this new graphing technique helps you visualize and share with clients the dramatic impact that retirement portfolio design and withdrawal rate has on portfolio survival.